I'm Nick Grove for Morningstar.com.au, and today I'm joined by Head of Equities Research Peter Warnes, who's here to discuss the latest earnings season, which draws to a close this week. Peter, welcome.
Thanks, Nick. Always a pleasure.
First of all, Peter, QBE was back in black with a profit for 2014, and it saw a decent rise in its dividend. But were you happy with the overall composition of the result?
Well, Nick, in a nutshell, no. I mean, it was thank goodness, there was no more kind of downgrades and write-offs and what have you, which has been, something that's stalked QBE now for too long. But having said that, it was a relief that the result was where it was. It was basically around guidance. They did miss two crucial things, but albeit very slightly. That was the combined operating ratio was just a little above their guidance range, and the insurance margin was also a little bit below their guidance range. Let's call it history. Let's close the book and let's look forward. So the composition wasn't exactly as we wanted. Not that came as any great surprise, because the North American operations were in turmoil, and that was the reason for many downgrades in the past. And now that that business has been restructured, a lot of divestments and what have you, going forward it looks like it's in much better shape. Where QBE was fortunate was that they had Australia Australia and New Zealand behind it. The Australian and New Zealand operations had a combined operating ratio of 87%, which means a big underwriting profit. If you've got a combined operating ratio of 100, that means you make the underwriting profit is zero. So that led to 64% of the group's EBIT coming from Australia. That's not how it's supposed to be in a global operation, and that's not how QBE management had planned it going back 3 or 4 years ago. And in fact, the North American operations, they made a slight underwriting loss. In other words, the combined operating ratio was just above 100, and they basically made no insurance profit. Now going forward, what's going to happen is, as I said, there's been restructuring right throughout that North American business. They're going to sell Argentinian workers' comp, which I don't know why they would even contemplate, that acquisition. But again, these are the things that have to happen, and they have. And so the forecast or outlook statement is much more achievable, despite the fact that gross written premium, which is the top line, and net earned premium will be lower than it was in 2014 because of divestments and restructuring. But importantly, the insurance margin is going to push up to between 8.5 and 10%. That's what the market's grabbed onto. That's why the market rebounded, and that's why we're relieved and pleased that we had stuck around, albeit that we've got a few bruises.
Peter, BHP's half-year result was in line with Morningstar's estimates, and it lifted its dividend. But are the cutbacks that Andrew Mackenzie's making the way to go, in your opinion?
Well, Nick, absolutely. And unfortunately, the planned cutbacks have come 2 years too late, both at BHP and Rio. There was just way too much, if you like, I'm not saying empire building or ego-driven expenditure at the top of the cycle, but that's what mining companies and resource companies tend to do. And hopefully, these sharp falls in commodity prices over the last 18 months or so has, really chastened them and saying, hang on a second, the capital allocation has been a bit skew-whiff. You've got to look at balancing up 3 balls that are in the air. That is growth opportunities, that is getting the balance sheet in a good condition, and then you've got to look after your shareholders. And that's what's happening. And I said belatedly. Look, free cash flow generation, terrific, despite the fact that this result was substantially lower because of lower commodity prices, but they've taken the knife to costs. And so the productivity has increased dramatically. The balance sheet's in pristine condition for a resource company of this size.
Peter, was Ramsay Healthcare's result as outstanding as its managing director, Christopher Rex, thought it was?
He could have been almost accused of underselling. It was a great result. I mean, and you couldn't pick anything wrong with it at all. I mean, the revenue line up 42%, the EBIT line up 32%, net profit up nearly 19% or 19%, and core earnings per share up 20%. I mean, a fantastic result. Australia again showing it's how good it is, up only about 9 or 10%, but 64% of the group. Where the kickers were, Nick, is that they're gaining traction in France now. The acquisition of Santé is really starting to come together nicely, and we're going to see a full 6-month contribution from that operation in the second half. That, together with the momentum within the business, allowed them to increase their guidance in terms of NPAT and core EPS from 14 to 16% growth to 18 to 20% growth. Now, just think about that, given the Australian economy and what have you, and you're talking 18 to 20% growth in earnings per share. And what's scary about it is that the demographics are behind them. They've got tailwinds. There's not too many headwinds. Ageing population. Governments wanting to put more and more money into healthcare. An increasingly wealthy community. All those things are in its favour. And as I said, scaringly, Christopher said that we're very comfortable with the blueprint if they've got here, and they think it can be rolled out in many regions throughout the world. Now France is looking quite good, but China is interesting. They've got a joint venture with Sime Darby up there, and that could open up many doors. So it was an outstanding result. But I think there's a lot more outstanding results to come.
Finally, Peter, did you get a look at Woolies' result this morning? And how's its food and liquor engine room running?
Nick, the food and engine room is running pretty smoothly, albeit that sales in the whole group were disappointed. Comparable sales in Australian food and liquor, which is the engine room, only up 1.7%. Deflation at 1.8%, so that's real growth of 3.5%. That compares to Coles at 5.5%. And petrol, we know those sales were down because the petrol price had fallen quite sharply from around $1.45 last year to, we've seen it at $1 in recent past. But more importantly, there's been a lot of speculation about the margins in Australian food and liquor and what Aldi and to a lesser extent Costco are going to do to both Woolworths and Coles. Well, there's absolutely no evidence at this stage that that is occurring at all, and that will annoy the people that shorted Woolworths because what's happened actually is food and liquor margins have gone up another 40 basis points in the half. They're now at 8.35%. Now that compares to Coles at only 5.2%. It's an engine room that's firing, and it's firing because of supply chain efficiency. Heaven forbid if we get some volume growth back in there, what they can do.
Peter, thanks very much for your time today.
Pleasure, Nick.